What is the foreign exchange market? When trading Forex, we are able to profit from movements of currencies. Those are continuously varying due to fundamental factors occurring across the globe, also known as news. In the old days, large financial institutions, corporations, central banks, hedge funds, and extremely wealthy individuals used to make all the money and dominate the Forex market until now. The emergence of the internet has changed everything forever. It is now possible for the average investor, like yourself, to buy and sell currencies from your laptop or smartphone. It is now possible for you to become extremely wealthy in the markets. The Forex market is open 24 hours a day from 5 p.m. EST on Sunday until 4 p.m. EST Friday. The reason that the markets are open 24 hours a day is that currencies are in high demand. The international scope of currency trading means that there are always traders somewhere who are making and meeting demands for a particular currency. Businesses, investors, governments, banks, and retail dealers like yourself trade and speculate on money which is made available through an internet agent, inevitably using probabilities, fundamental/technical evaluation to predict the currencies to move either up or down. The currencies are traded in pairs, for example, US dollar, Japanese yen, or Euro US dollar. Anybody anywhere can gain from the proper judgment and management of the constant price fluctuations. The foreign exchange market is the largest and most liquid market in the entire world, with an average daily turnover of $5.8 trillion, making the stock market look small, which is only in billions. As soon as you're familiar with a currency pair and your research indicates a particular position which you feel you may profit from, you may then work that position all night and day if you desire, enabling one to potentially collect greater gains in a shorter period of time than you could achieve if you were to trade stocks. The history of the foreign exchange market. Back in 1931, the gold standard was used to describe any money that was pegged to the quantity of reserved gold. For example, if you had 10 US dollars, you could take it to the government and exchange it for a predetermined amount of gold. From 1931 up until 1945, there was a 14-year period where fiat money, non-backed paper currency, was dominant, which led to enormous financial imbalances from country to country and was a big contributing element to the start of World War I. The market experienced fast-paced evolutionary alterations from 1931 up until 1970, which the period had a terrific effect upon the global economies. The foreign exchange market was fully established in 1971, but from its infantile stages throughout the Middle Ages up until World War I, it had been somewhat secure and didn't attract much risky activity or the interest of investors. It was only until after World War II, however, the markets began to obtain volatility and speculative activity amplified tenfold. The government change in coverage was released near 1963 when the new Federal Reserve notes, without any promise to cover lawful money, were started without any guarantees and no worth. Currencies of the main industrialized countries climbed to become free-floating and hence becoming subject to the costs set for them at the actively traded Forex market. As speculators and dealers gained a high interest, the liquidity started to steadily improve and costs fluctuated each day. In the early 1980s, the telecommunication and computer industries grew, helping the international financial markets to develop worldwide. All markets subsequently grew to become available to everyone regardless of the time zone and time of day. Trading was only available through mixtures of technological advances, communicational and political improvements. All charting needed to be done by hand on paper, whilst all trading orders needed to be conducted via phone. Transactions in the currency market increased from about 68 billion daily in the early 1980s to over 3 trillion a day in 2006, though it didn't become widely electronically tradable until the 90s. The Forex market is now estimated to be turning over 5.8 trillion and also is growing day by day as more and more aspiring retail traders are comprehending the marketplace alongside its profitable potential. As a result of technological breakthroughs of the internet and the massive number of brokers available worldwide, the largest modern day currencies stream independently from different currencies and are traded by any person who wants to do so. Central banks have been seen to sometimes intervene in an effort to move currencies to their desired levels. Why trade Forex? Freedom. Whether you're working from an old laptop or the latest smartphone, living in a luxury multi-million-dollar apartment, or in a remote village in Asia, you can trade Forex from absolutely anywhere. All you need is an internet connection. This type of freedom allows you to begin trading alongside another career or your favorite hobby. Or maybe you would just prefer to sit and relax on a beachfront pip chasing. It is completely up to you, and that is the beauty of it. A 24-hour market. The Forex market is the only market that operates on a continuous basis, so there is no waiting for the opening bell. From the Monday morning opening in Australia to the afternoon close in New York, the Forex market never sleeps. Forex trading, however, is not available on Saturdays and Sundays. Some traders wish to trade on a part-time basis because you can choose when you want to trade: morning, noon, night, during breakfast, or in your sleep.
Highest market trading volume. The Forex market has the highest market trading volume out of all of the markets. The daily volume can range from 5.8 trillion US dollars to 6 trillion US dollars. No other market can compete with this volume of trading. No middlemen. Spot currency trading removes the middlemen and lets you trade directly with the market responsible for the pricing on a particular currency pair. No fixed lot size. In the futures markets, lot or contract sizes are determined by the exchanges. A standard size contract for silver futures is 5,000 ounces. In spot Forex, you determine your own lot or position size. This allows traders to participate with accounts as small as $50, although we'll explain later why a $50 account is a bad idea.
Low transaction costs. The retail transaction costs, the bid-ask spread, is typically less than 0.1% under normal market conditions. At larger brokers, the spread could be as low as 0.07%. Of course, this depends on your leverage, and all will be explained later. No one or exchange controls the market. The foreign exchange market is so huge and has so many participants that no single entity, not even a central bank or the Incredible Hulk, can control the market price for an extended period of time. High liquidity. Because the Forex market is so enormous, it is extremely liquid. This is an advantage because you will never be stuck in a trade. You can even set your online trading platform to automatically close your position once your desired profit level, i.e. a limit order, has been reached, and or close a trade if a trade is going against you, i.e. a stop loss order.
Low barriers to entry. You would think that getting started as a currency trader would cost a ton of money. The fact is, when compared to trading stocks, options or futures, it doesn't cost a lot to trade. Online Forex brokers offer mini and micro trading accounts, some with a minimum account deposit of $50. I'm not saying you should open an account with the bare minimum, but it does make Forex trading much more accessible to the average individual who doesn't have a lot of startup trading capital. All currency pairs are quoted and valued against each other using 5 decimal places, with the fourth one being the pip. The fifth decimal is known as a pipette, which is 1 point of a pip. However, this rarely needs to be considered. The fifth decimal increment isn't always displayed, depending on the agent, and isn't too vital to take note of. Example, Euro US dollar. So we can see here that this is an increase of 5 pips. So if you have a look in the red, you can see that the price is 1.6900, and then it went to 1.6905. So you can see here that that price went up 5 pips. Now on the other hand, you can see 1.6000 and it went to 1.5995, and this would be a decrease of 5 pips. Another example, Aussie US dollar. We can see here that we've now had an increase, so the price is 1.4490, and we can see this has increased to 1.4590. So we can see this would be an increase of 100 pips. On the other hand, we can see the price is 1.2490, and this went to 1.1919, and this would be a decrease of 571 pips. Pairs that involve the Japanese yen. Yen-based currency pairs are an exception, where the pip is given to 2 decimal places. The third decimal is, as previously mentioned, known as a pipette. Further example, US dollar JPY 192.33, and we can see that the price went from 192.33 to 192.38, and this would be an increase of 5 pips. On the other hand, the price is 192.33 to 192.28, and this would be a decrease of 5 pips. So just remember that this is with the yen pairs we're just doing examples of now. Another example we can see here, Great British Pound, Japanese yen. We can see here price is 146.78, and it went to 148.70, and this would be an increase of 192 pips. On the other hand, the price is 146.78, and it went to 139.80. This would be a decrease of 698 pips. So just make sure that you can go over this section and just study how pips work, because you will be using it in your day-to-day trading. Many traders focus on the monetary factors as an indication of their success. However, a true trader counts the pips, and the money will follow suit. Ensure your main trading aim is that of making pips, keeping pips, and repeating until pip excellence is achieved. The first currency of both displayed on a quotation board is called the base currency, whilst the second is referred to the quote/counter currency. Essentially, the base currency is the foundation for the commerce. So, if you purchase Euro US dollar, you're purchasing euros, foundation, and selling dollars, estimate. And if you sell Euro US dollar, you're selling euros and purchasing dollars. Whether you buy or sell a currency pair, the implementation is always based on the first currency. For instance, if you wanted to obtain the US dollar Japanese yen, the exchange rate tells you how much you will need to pay regarding the quote/second currency, so as to purchase 1 unit of the base/first currency. In case you were to sell the currency pair, US dollar Japanese yen, on the other hand, then the request price/exchange rate would show how much of this quote/second you will get for selling 1 unit of this base first currency.
Spreads. Spreads are based off the buy and sell price of a currency pair. Spreads are variable and can change during news. Watch for normalization of spreads soon after an economic event. It is imperative that new traders become familiar with the spread. When news events are released or markets have high volatility, the spreads tend to also rise too. So the first thing you will do before you put on a trade is check the spread. Large liquidity providers do not know the result of news events prior to their release. Because of this, they look to offset some of their risk by widening spreads. It is crucial to remember that spreads are variable, which means they will not always stay the same and will change as liquidity providers change their pricing. Each pip is 0.10 or £1/$1 equals 1,000 units. 1 times standard lot basically means each pip is 1.00 or £10/$10 if you're in the US, and this equals 100,000 units. These calculations are based off MT4. When using MT4, it gives you an extra digit, so 0.05 is not 5p or 5 cent, it's actually 50p or 50 cent per pip movement. So just remember, we are not financial advisors, but based on users who have traded with us, these are trade size positions they took. We recommend trading only 0.1% of your account per trade. Active Forex market hours. The active hours of the Forex market is open 5 days a week, 24 hours every day. Before considering the best times to trade, it's vital to first look at the 24-hour Forex market chart below to see what a trading day looks like. The market can be split into 4 significant trading sessions, and these are Sydney, Tokyo, London, and the New York session. The London and US overlap session has the most liquidity in the Forex market. And if you just have a look at the chart below, you can see exactly what times they actually start and also what times they actually end. And you can see the London and the New York overlap in red and green. Majors, minors, and exotic currencies. Currency pairs can be classified into three classes: majors, minors, and exotic. The majors are the most popular, so subsequently hold the most liquidity and are far cheaper to trade concerning spread costs. Major currencies: US dollar, euro, Japanese yen, Great British pound, and the Swiss franc. Minor currencies include Australian dollar, Canadian dollar, New Zealand dollar, Danish kroner, Norwegian kroner, Swedish kroner. Exotic currencies include Hong Kong dollar, Mexican peso, Singapore dollar, South Korean won, South African rand, Russian Federation ruble, and the Indian rupee. Forex 101. Forex trading. Forex trading is a simultaneous exchange of buying and selling one currency for another, specifically for speculative purposes. Forex, also known as foreign exchange, Forex or FX, is the largest market in the world in terms of volume, trading over $5.8 trillion per day. Trading basics. Forex 101. Trading basics. Forex trading is the exchange of one currency for another. Euro-US dollar rate signifies the amount of dollars you can buy using 1 euro. If you feel the euro will increase, you would buy the euro using dollars, and when it appreciates, you sell the euro, making a profit. Forex quotes consists of the base currency, left-hand side, and the quote currency, right-hand side. The base currency is the currency what you are willing to buy using the quote currency, and the rate you see is how much the quote currency is needed to buy 1 unit of the base currency. So you can see in this picture, we can see the base currency, which is the euro, on the left-hand side. And basically, this is the currency you want to buy or sell and are quoting for. And on the right, you can see the US dollar, which is the quote currency. So you can see that this is the currency you own and are quoted from. So we can see here towards the right, we can see the ask, the bid, and also the spread. And the spread is basically the difference between the buy and the sell price. Forex margin. Forex margin is the initial amount of money needed to open a trade. The margin is determined by the amount of leverage you choose. You can choose Forex leverage from 50 to 1, i.e. putting down payment of 2% of the full value of the trade, up until 500 to 1, whereas only 0.2% of the trade is needed. We recommend using 100 to 1 or 200 to 1 leverage. Now, what is leverage? The definition of leverage in Forex is the ability to trade a large amount of money using very little of your own money, as little as 0.02%. What is margin? The margin in Forex is the deposit needed with the broker to open a trade with a greater value. The percent margin depends on the leverage the trader uses. You can place a margin range from 0.2% to 100% of the value of the full trade. Spread betting versus CFDs. Spread betting and CFD trading equally offer leverage trading on a selection of markets, including Forex, indices, shares, crypto, and commodities. However, while they share many benefits, there are key advantages to each. For example, UK residents won't have to pay capital gains tax or stamp duty when spread betting. Spread betting: no capital gains tax, no commissions, just a spread. Easy to bet in the currency of your choice. Greater control of currency exposure. Deal on rising and falling markets. Leverage access to the markets. No stamp duty. 24-hour dealing. Use prices based on the underlying market. So this is basically the benefits of spread betting. CFDs, direct market access, DMA, on Forex and shares. Trade at the market price of shares. Losses can be offset against profits for tax purposes. Deal on rising and falling markets. Leverage access to the markets. No stamp duty. 24-hour dealing. Use prices based on the underlying asset. So this is for CFDs. So depending on what country you live in, it may vary. So the changes may vary. So it's always best to check what's on offer in the country that you're living in. Which is best for me? If you're proficient in the financial markets, both spread betting and CFD trading can bring variety and range to your portfolio. Spread betting could be for you if you want any profits to be tax-free, you want to control the size of your deal, you want to deal shares in smaller sizes and not be penalized by the minimum commission, you want to deal all international markets in sterling, you want to take a longer term view on Forex and shares with forward markets. CFD trading could be for you if you're already comfortable with the underlying market and its terminology, so want a product that feels similar. You want to use DMA for shares and Forex trading while getting OTC benefits. You want to offset losses against profits as a tax deduction. What are the technical differences? A financial spread bet allows you to speculate on the financial markets. You are not trading the markets, you're betting on the range of potential outcomes based on the underlying data. A CFD is a financial derivative. You trade a contract based on prices derived from the underlying market via DMA. You trade a CFD and the broker places a parallel trade in the market. So these are basically the differences between CFD trading and spread betting. Short selling. The concept of short selling often confuses most new traders. Most new traders say, how can we sell something if we don't own it? Short selling began in the stock market before Forex was even thought of. Traders that prefer to speculate on the price of a stock going down developed a fascinating mechanism by which they could do so. Traders looking to predict the price falling down may well not own the stock they want to bet against, but likely somebody else does. Brokers started to see this potential opportunity. Short selling in the Forex market. In the Forex market, however, transactions are treated differently than stocks. Each currency quote is presented as a two-sided transaction. This indicates that if you are selling the Aussie US dollar currency pair, you are not only selling Australian dollars, but you are buying US dollars. If you buy the GBP AUD currency pair, you are buying British pounds and selling Australian dollars. If you sell the AUD JPY currency pair, you are selling Australian dollars and buying Japanese yen. This is short selling 101.